Chief Equity Strategist at Deutsche Bank. Binky, it's great to speak with you. And let's start right there, because so far, maybe Netflix and Texas Instruments notwithstanding, it does seem like it's been a pretty strong earnings season.
Yeah, I think, bigger picture, one wants to keep in mind that basically over the last 2 years, S&P 500 earnings have basically bobbed up and down around 11% earnings growth. 11% earnings growth happens to be the historical average outside of recessions. So we were a little bit lower at 9.5% in the second quarter. And right now, we were looking for sort of 11.5%. It looks like we're getting 12.5%, basically. So a little bit better than even we expected, but broader, bigger picture, it's the same picture. It hasn't really changed very much.
So in light of that, what drives us to 7,000 on the S&P? And I ask that knowing we're under a little bit of pressure again today. 66.91 is the level there.
Sure. So I would say, earnings doing what they've been doing, and you've got to remember that the equity market's down pretty well over that period. I would add basically to that given the events of the last 2 weeks, what we've basically seen is equity positioning, for the market as a whole, basically moves to neutral. But if you look at, what we think is the most important part of the investor base, which is discretionary or fundamentals-based investors, they've moved basically to underweight. So normally their positioning tends to align with earnings growth. Right now, their positioning is aligned with slightly negative earnings growth. And as we were just talking about, we're getting double-digit earnings growth. So there's quite a gap between what they're positioned for and what we are getting. So view that basically as an upside. And last but not least, I would remind that, we've been having basically a big boom in inflows across asset classes. And equities, of course, have also benefited from that. So solid earnings, yes, might be the same thing, but given all of the uncertainties, the risks and the concerns, it's a positive if we get what we've been getting, which is pretty decent earnings growth. Positioning is underweight, and the inflows boom, continues basically.
One of the interesting things to me is the fact that so far in results we've gotten and commentary we've gotten is it hasn't just been this AI infrastructure investment fueled cycle that is driving the numbers higher. It's also some of these more consumer-facing companies that, okay, even if maybe they're struggling with a turnaround or some such, are talking about improvement, especially as you go into these final months of the year.
Yeah, we are relatively bullish. But I think, one wants to be fair to the facts. I think, one of the aspects of the last couple of years has been that earnings growth just really been dominated by, it's responsible for 87% or let's say 90% basically of earnings growth for the S&P 500. So, key part of the thesis is, earnings will broaden out. And we're clearly seeing that basically to some extent in the current reporting season. But, the stories are not really about macro improvement or industry demand improvement. They've all really been of the self-help and, get increased market share variety. So it's not speaking loudly to the broadening holding out, though, of course, all companies can do that. And of course, focus on efficiency and cost cutting. And cost cutting is not generally good for the macros, the way I would put it.
So in light of all of this, how would you be positioning yourself as an investor across sectors and different parts of the market?
So our positioning is, overweight really is got a cyclical tilt, basically. So we've been along the financials, we're along the cyclical parts of the consumer, we're along cyclical parts of the industrials. If you think and go back to what I was saying about positioning, discretionary investors, basically, we're sitting at neutral since July, despite the market running up. They've now moved to underweight. They have, I would argue, the common denominator of their concerns is really cyclical risks. And so the question is, if earnings growth is running much stronger, and they, relent or capitulate, what are they going to buy? buy. I would argue if their concern is cyclical growth, then they will buy the cyclicals if they start to show signs, basically, of their earnings improving, which, we see to some extent. I don't want to overstate the case yet.
Okay. Bankim Chadha with Deutsche Bank. Thanks for kicking off the hour with me.